We've got Arnab Das, who's Managing Director at Rubini Global Economics. He joins us on the show from London. Now, Arnab, to begin with all the continuing uncertainty that we're seeing in the euro area and also the weak growth in the US, we should ideally have seen more money moving in the direction of emerging markets, which isn't really happening. What's the big worry that investors have with EMs?
Yeah, I think that's an excellent question. I guess there are two things going on in emerging markets that probably explain the slowdown in capital flows from developed countries to emerging market countries, and maybe one important thing in the developed world. I'll start real quick with the developed one. There's a source of enormous uncertainty that continues about what the growth picture will look like in 2012, 2013, and even thereafter. The cutting edge of that, of course, is the Eurozone, the potential Eurozone crisis, the double-dip recession that's emerging there, and also the threat of some sort of unresolved, potentially even catastrophic event risk in the Eurozone should there be more defaults at the sovereign level, maybe cascading bank defaults, and even some Eurozone exits. Now, that risk has been mitigated several times now, not least recently by the ECB and its long-term refinancing operations, but with the pressure re-emerging in Spain, that might be a risk. Also, in the developed world, the United States might have some significant recessionary forces, or at least slowdown forces, in its economy in 2013, should there be a significant fiscal adjustment, what everyone's calling a fiscal cliff. But of course, that affects capital flows around the world, everywhere, including domestic capital flows into and out of risky assets in the developed world. The emerging market part of the story that might be more of a problem, I would say, is twofold. One is cyclical, and that is the slowdown that's taking place in most of the major emerging market countries, including the BRICS. And that slowdown, in turn, owes to the lagged effect of monetary tightening that's taken place over the last couple of years, that's now starting to show up and causing many emerging markets to have to ease.
Right, so Arnab, just focusing on the BRICS region, do you believe the BRICS economies have lost their shine, and do you believe, again, that it is time for investors to be chasing other growth stories?
I think there's been a lot of hype about the BRICS. They're very different countries than each other. About the only thing that unites them is the acronym and the summits. So it's kind of hard to generalize. So I would say that I would agree that they have lost their shine. There are probably higher potential growth stories around the world, but those countries are going to be relatively small, even though the BRICS do not necessarily have the deepest financial markets. The other countries will have even smaller, thinner, less liquid markets. And the BRICS, I think, will continue to be a mainstay in quote-unquote emerging market portfolios, and will eventually become, sooner or later, mainstays in global portfolios, assuming that we don't have deglobalization and liberalization of capital flows continues. So I would say that the shine is coming off, but that doesn't mean that the BRICS are not going to be even more important in the world economy and in global financial flows and portfolios.
All right, Arnab, afternoon. If you could just tell us about what you make of the Indian region, the confusion on the tax laws and the regulatory inertia aside, what's the big concern that you think investors have with India?
I think, like I was starting to say before, I think it's a combination of cyclical, economic, structural, and political governance issues that are all coming to a head at a time when India is slowing down, and at a time when the environment for capital flows is not so conducive, with Eurozone banks deleveraging, and still concerns about a U.S. slowdown or a fiscal cliff in 2013, and some sort of event in the Eurozone. Of course, India has a current account deficit, which has been increasingly financed by quote-unquote hot money portfolio flows rather than FDI in recent years. So that makes the currency and asset prices, liquid currency and relatively liquid asset markets, more vulnerable than they would otherwise be. So India does have some challenges to address, stepping up the pace of reform, reining in corruption, reining in the subsidy regime, investing better and longer term both in infrastructure and education, and irrigation and basic, clean running water and various other things would make a huge difference and probably move the needle in the dial away from hot money towards FDI, which would make the current account deficit that much more easily financed and sustainable.
Oil also emerges as one of the big worries for India. Where do you see oil prices headed? And should we see Brent crude break past $140 per barrel? What should we expect to be the impact on India will be? Because there are already those who see the rupee heading towards 55 towards the greenback before the end of this year.
Yes, oil is a perennial worry for India and will continue to be for at least some time. We expect a kind of a bit of a downward drift in oil prices in the short term, but still very elevated levels of the oil price for obvious geopolitical concerns as much as anything else, such as strong demand. Although the demand is relatively strong, the slowdown in the world economy implies somewhat weaker demand at the margin. The problem is that there is a fear premium, and that will remain relatively elevated. I think compared to past instances of very high levels of the oil price and very sharp increases in the oil price, India is in much better shape, notwithstanding all the concerns about Indian economic performance and governance issues, structural reform, what have you. And that is because reserves are very high compared to other periods of sharp increases in the price of oil. And in addition, the price of oil has been gravitating upward, allowing time for some adjustment in the global economy and also adjustment in administered prices of gasoline and end user products that are based on crude oil, including in India and other places. So the downside is nowhere near what it has been in previous crises, which is good news, but also probably helps to explain in some part why there is maybe not exactly complacency, but lack of forward momentum in structural reform and liberalization from the Indian government.
And lastly, Arnab, given the various headwinds to growth that we are seeing across the world, would you argue that the growth forecast for 2012 and even 2013 being put out by the likes of the IMF and even the World Bank are somewhere being too optimistic?
I think the upward revisions that have taken place in a number of forecasts around 2012, part of 2013, including our own, which I hasten to add, although we've revised growth forecasts upward, we remain well south of consensus in terms of growth. Those upward revisions from the IMF reflect, I guess, the hope and the prayer that the ECB's LTRO, long-term refinancing operation, will have stopped the worst from happening in Europe and allow for much more gradual, much smoother adjustment than what, in our view, is likely to take place. Hence, we're south of many other global forecasts for the coming year and a half, 2 years.